Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about EXIDE industry, whether it is a buy after the Q2 numbers or an avoid. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Exide Industries, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel. It will help you also ask me questions on a greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, a number of podcasts that I put up every day, and also a number of articles that I put up on stocks and markets. There is a watch list which has around 70 stocks which gets updated every week to 10 days as to when to buy those stocks, what are the buying range, etc. For detailed market or company talk, kindly contact me directly on email and we can work things out. Now about the company, Exide Industry, established in 1947, provides automobile batteries for 4 and 2-wheelers. Marquee brand in auto ancillary, and most of the people would be aware of. Top clients and strong retail appeal clients include Maruti, etc., and Hero and Bajaj, etc. Batteries are of both the types which could be taken out and which are assembled into the vehicles. They also provide industrial batteries, UPS batteries, solar panels, solar batteries, etc. The market cap of the company is around 16,000 crores, and it is a prominent brand. As I explained, it is one of the most prominent brand that is available in the market today. If you look at the numbers, and the second quarter numbers had just come in about a week, 2 weeks back, sales were up actually. This is not negative, but were up around. So sales were 4,030 crores, up 6.25%. Profit was up 3.5%. So probably the sales and profit numbers are coming back to the pre-COVID levels as we expected, but I think next 2 quarters we could see a little bit of surge. But FY22 looks like could be extremely good for the ancillary business, especially for batteries and autos. Interest cost has risen. The net profit margin is around 9%. Operating profit margin also around that, around 10.5%. There's very high promoter and institutional holding, and only 11% free float is there, and that is an extremely positive sign. So basically, numbers tells me that growth is coming back, that we are in the flatter trajectory. But when will the growth really surge? Probably FY22 would be that time. So next 2 quarters might still be flattish to a slightly positive, but FY22 could be pretty good for the auto ancillary business. What has been the reasons for disappointment or decline for the stock and the results? Apart from what has happened with respect to the shutdown, with respect to the businesses not working that well because of local shutdowns that has taken place, and shops being closed, and that the people are not moving from one place to another for offices, etc. So lesser number of cars being used, so the battery consumption is less. Apart from those reasons, what are the other reasons? So that these are obvious reasons as to why the company has not done well over the last 6 months. Apart from that, global auto slowdown has also hurt. So it is not that the problem has started just 6 months back. From FY18 onwards, from around 2017 February March, the problems started to kick in from the growth perspective here in India as well as in Europe and US, and that has hurt the business of auto companies, whether it is ancillary or original manufacturers. So over the last, you can say, 3 years, the whole of 17, the whole of 18, 19, and now 20, things have been extremely difficult for this segment, and it is continuous. So that is why I'm saying that the next 2 quarters might be flattish to an extent or slightly positive, because in an inherent way, the growth for the sector has not come back, and the problem lies with the core growth that has not happened over the last 3 4 years. Domestic sales have slumped from 2018 January onwards, and so again 3 years of declining domestic auto sales. Raw material cost has scaled up. So 2016 we had oil at around 16 to $20 per barrel. Today it is 40 to $45 per barrel. Plus there are other raw material cost of metals, steels, etc., that has run up, or other products. Margins have shrunk, so you need to understand that original manufacturers are always the best in the class when it comes to negotiating prices. And that is why most people ask me on Patreon and on YouTube as to why not buy into ancillary plays, because something like a battery company would be serving all sorts of automobile companies. So that's the best way to play the automobile sector. But you need to understand that margins of ancillary plays will always remain lower than the original manufacturer. So just to give you an anecdote on that, and an idea on the same fact, Dixon Technology before FY21 had margins close to 2.7 to 3%, whereas for companies that they are making the products, say Xiaomi or Samsung, or other companies, they're making televisions for Xiaomi, phones for Samsung, etc., their margins are in the mid teens or late teens, etc. So that is the kind of difference that you have, or even larger. So that is why I would probably trade or go low on ancillary plays and buy big into say original manufacturers. So margins are a very important factor here. Strong competition from other brands, and we know about Raja batteries, other batteries are there which are doing very well. Other foreign batteries are also there. So manufacturers are plenty, local manufacturers are there, which provides batteries at lower prices. So there's a strong competition, and next 2 quarters could be tough. Now that is what I'm trying to say. So December and March quarter might not be that rosy as the September quarter has been, because of the fact that June quarter has been extremely bad. That's why September looks really good. So you have to be a little bit careful, and probably that's why the stock has not surged a lot even after decent, you can say, Q2 numbers. If you look at the technicals of the stock, then the 200 DMA has remained around 160. This stock has been consolidating between 135, 140 on the lower side to 165, 170 on the upper end. So this 30 rupee range is continuous over the last 5 6 months. So the consolidation is there. There could be a surge and then another decline. So that is why I would say that if you like to buy, probably buy over a period of time. It has run up over the last few months, so you have to understand that in March it was down, I think 120 or 110, something like that. So it has run up 40 50%, but still it is down around 50% from 2 years high. And if you talk of strict technicals, then 198 200 is a strong resistance. 145 on the lower end is a strong support. So any 7 8%, 5 6% decline, then you should look to get into something like EXIDE. So in my opinion, my call is that you can buy over the next 6 months. I think till March, April you can buy. Next 2 quarters might not bring you very big news, so the stock may remain in a range. Sales are coming back, and that is a very big positive. Maybe recovery may take another 2 quarters, but I would believe that FY22 could be very, very interesting for autos and auto ancillary, and then you will see a surge in Exide as well. But I think I would prefer original manufacturers over batteries, and buy only 5% of your total portfolio. So this was my video on Exide Industries. Please like and subscribe my channel and hit the bell icon so that you get my videos straight away when I post it, and kindly support me on Patreon. Thanks a lot for watching.